here and all across the country are suddenly paying a lot more for some of their medications.
Drug prices are skyrocketing in Florida right now.
Drug makers just upped the prices on many of their prescription drugs.
Are drug prices increasing because of pharma, or are they increasing at a rapid pace because of the asks being done by the PBMs and carriers?
People are dying because they can't afford their medication, and you all are part of the problem.
The answer is no, not even close.
An anonymous insider reveals the truth about drug pricing, explaining how pharmacy benefit managers and carriers influence drug costs and insurance companies raise costs with hidden tactics.
If you were to really understand the U.S. supply chain of pharmaceutical product, it's very stable. But the whole point of it is there's not this erratic behavior in pricing. Primary objective of this business model was to squeeze as much money out of a very overly complex and opaque pricing system. I think the biggest disservice to the American public today is there's no understanding of what real drug prices are.
Welcome to Healthcare Confidential, a show where we demystify the broken and convoluted world of healthcare by talking to executives completely off the record. Today, we have a pharma executive here who's going to tell us a little bit more about how the world works. Thank you for being here. Let's start from the top. How does a PBM work? And what's the history? How do the PBMs work, and what's the history of PBMs? Because it's a pretty interesting history in where it's started and where it's landed today.
Well, I think where it started on some level, and you could trace its roots back to all the way late 60s, early 70s. And, if memory serves me correct, there was a company called PCS, which would later become Advanced PCS. And some may say that was the beginning of everything. They offered some sort of credit card-like processing system. And it used the old bank identification number. So like the first 5 digits on a credit card is the same exact system to process a claim using that same kind of sequencing. And so what they were really trying to address is you have pharmacies. Is there an electronic way to process a claim versus kind of way back in the day having a shoebox of receipts? Like this was a Cigna claim, this was an Aetna claim, this was a Blue Cross Blue Shield claim, and the local pharmacy or chain pharmacies would have to then reconcile, like you owe me $80 for this one, you owe me $14, and that could be a handful. So obviously, was there an electronic modality that they could leverage? In this case, the Standards Institute had the bank identification number. And to this day, bank identification numbers are the sequencing on someone's card. But the whole idea it started from is how do we create a more streamlined workflow for these hundreds of thousands, millions, tens of millions prescriptions. I think you're beginning to see in that period the expansion and importance of retail pharmacy. And then when you get into the 70s, you start to see ERISA, I think 1974. And what was important about ERISA is it allowed for defined self-insured rules. And this, you began to see the expansion or adoption of self-insured benefits in pharmacy. And you start to see other players, join PCS, like Diversified, and these are claim processors. And you see the expansion through the 70s and through the 80s. And really what is a PBM doing is they're starting to focus on what I call a layer of claim processing. Like there is some sort of benefit being presented and a price. There's a pharmacy that's fulfilling the prescription. There's some sort of entity that's offsetting or paying the full cost of the actual drug. There may be a copay from the member in there, and reconciling that information. And later this would expand into the 90s into more of a full service, like there's a call center, and we're going to print the cards and the member information. We're going to have maybe an account management team, and you're beginning to see, what I would say the true beginning of a PBM industry. What's interesting also in this period of time is that PBMs charged flat administrative fees. They hadn't yet had a glimpse of what would become spread pricing and later on more vertical integration that we'll talk about.
Yeah.
And you see companies like Merck Medco. So Medco was a PBM, but it was owned at one point by a large manufacturer, and other manufacturers owned different PBMs. And what happened is there was pressure that perhaps there was a conflict of interest, that if you're the administrator of a pharmacy plan and you're sourcing your own drugs or featuring more prominently your portfolio of therapies, that perhaps you don't have the best interest of heart. You know, there could be a conflict of interest. And so rapidly in the 90s, as rapidly as the manufacturers bought these entities, they divested themselves of them. And this is where you begin to see the real owners emerge. You begin to see companies like Caremark. Mm-hmm. You begin to see companies like Express Scripts. And you're suddenly seeing the beginning of the independent claim processor or pharmacy benefit manager, where they're no longer attached to the manufacturers and they've evolved rapidly away from just processing a claim. They're providing clinical oversight. They're developing formulary strategies. They're looking at fulfillment and network management and network strategy. You know, they're broadening their umbrella of services, and they're really taking shape, I would say, right at the turn of the 21st century into what we know as a traditional PBM.
If we fast forward to today, 2024, you mentioned conflict of interest. There's been a lot of consolidation in the healthcare market broadly, but there's also been a lot of consolidation in the PBM market. So, like, how should a consumer think about that?
Well, I mean, I think the interesting evolutionary points in pharmacy benefit management, and again, this is an opinion, is, you know, the first one was the true formation of a PBM. You have these entities now like Express Scripts and Caremark in market. The first conflict is they developed, you know, a unique strategy, which is, what if we were to present to the payers, and this could be health plans as well as employer groups, unions, municipalities, instead of having fees, what if we said there were no admin fees, zero administrative cost, and we're gonna take the money from the actual transaction? Like, we're gonna claw, like they're trying to present it as pharma is the enemy. And let's be frank, not many people are shedding any tears for pharma, period, full stop, especially in this moment in history, because you're starting to see the rise of prescription costs. You know, I often say if you go back to the 70s, the average cost of prescription might be $4. If you go to the turn of the century, you're probably creeping up into the $40 range. So you're already seeing this kind of 10x ramp over this period of time. So people are starting to, you know, feel a little pain, blame pharma for these things. And PBMs were very smart. You know, it was a brilliant marketing tactic, because what they're presenting is there's no fee to use my wonderful services. And I'm going to beat up the manufacturers to get you better prices. And whatever my fee may be, I'm going to take out of them. And everyone's like, oh my gosh, this is amazing. And now you start to see, if you were to actually look in the first decade of the century, the best performing stocks during this period are companies like Caremark, Express Scripts, and Medco. It's fascinating. They exploded in popularity, riding the rails of ERISA, obviously self-insurance, and that started to go downstream. This no longer was the domain of Fortune 50 companies. It was anyone who's really 1,000 lives and up, you could be self-insured. And you also saw expansion because carriers needed help. They didn't have the capabilities. So Blues plans, regional health plans, some of the largest carriers of the day were using them on the back end, like Cigna, Aetna, United Healthcare. They hadn't yet figured out what we will come to, vertical integration and tying all of these things together. But what was, you know, back to the conflict of interest is, if you're paid on drug spend, you could create a bias, and the bias could be the more expensive the drug, the more money I make. The more wasteful the product or even the utilization, the more money you make. And so you suddenly start to see, an uptick in price. And people can argue about this all the time. Who's driving drug inflation in the 21st century? Now, I would argue in the first decade, it still was pharma. Because they're like, once you have a patent, you've been awarded one, you have an expiration period before you're going to run out of time. And depending upon how long you have in clinical trials, that could be anywhere from 7 to 12 years, let's just say, but on average, and the clock's ticking. So historically, what manufacturers do is they raise price each year, and the PBMs picked up on this and they said, well, what if we were to create not just a formulary, but some sort of formulary management where we had preferred and non-preferred products? Like, what would happen? Would pharma pay me more? And really what they're trying to say is, let's just say we have two drugs, and one has a copay of $20, you're my preferred product, but the other one has your non-preferred, it's $50. Well, you're going to change patient behavior pretty quickly. And what they saw in the early tests was this has a strong result, that they could change market share. And once you demonstrate market share shift to pharma, they'll pay for it. And so right around, this is an estimate, is the end of 2007, you're starting to see this fundamental shift in power, where I believe pharma controlled the supply chain, and then the PBM started to gain control through formulary management, because you want to be on formulary. You're starting to be beholden to the end layer of accessing the patient, the plan, etc. And it was a very interesting period of time, because when you think about it, you start to see other people in the supply chain understand the value of a PBM. So I think it was 2007, you see CVS pick up Caremark. And you're like, well, wait a second, a retail pharmacy owns a PBM? And everyone kind of shrugged their shoulders like, who cares? You know what I mean? Like, whatever. Like, as long as it's not pharma. Like, pharma, that was bad. But retail, maybe I could live with that. And so you begin to see the first, what I would say, retail integration. The first kind of the beginning. I don't want to say full vertical integration, but
that'll come.
It'll come. But you're starting to add a layer, but you're still seeing the biggest players are CVS with Caremark at this point. You're seeing, obviously, Express Scripts, still independent, and Medco. These are the leading players in this field. As you start to move into 2010 and beyond, you're starting to see names like Catamaran, which is a new independent PBM. And suddenly, some people say, I need that capability. Like, I'm a carrier. These are the ones that start looking at it and saying, I really don't have much of my own capabilities here. Maybe I should have this capability. And so I think the first one where you saw something unique happen is United bought Catamaran. This is 2016, roughly. And that sent a ripple effect through the industry, because now you've got something that's a carrier and a PBM coming together. And obviously it's being billed as this is good for patients, and there's going to be savings, and we're going to have all this data to create these cool insights to help the patient improve upon it. But everyone wanted to copy it. So shortly after that, you're seeing by 2017 mergers announced of Aetna and CVS. And wait for it, Cigna coming together with Express Scripts. And also in that period in 2013, around then, Express Scripts bought Medco. So now you're ending up with 3 large carriers that own 3 large PBMs, and one owns the second or first largest retailer, depending for pharmacy, depending upon how you want to do the math there. And so the world has changed quite a bit. So think about it. We went from 3 independent, smaller, fragmented PBMs to 3 of the largest carriers suddenly having massive market concentration. And the other thing that they realized during this period of time was, let's further the vertical integration. What if we were to have mail order? And now mail order is a concept that started even in the early 2000s, but the part of what they would call later home delivery that really took off was specialty. They're like, well, there's some really significant margins on these high-cost biologics. And by the time we hit 2015, all of the major carriers / PBMs wanted in. They all bought their own specialty facilities or were building them at scale or rebuilding old ones. They couldn't get enough production and capability through it. So by the time the paint dries and we're here in the modern day, if you think about the full integration, you have a carrier. Some have retail capabilities. They all have mail and specialty capabilities. They all have formularies, but they've evolved even beyond the preferred, non-preferred status of formularies. They're now driving full exclusions. Like there's 5 of you in manufacturers in this therapeutic category. I'm going to keep 2 of you. Let the bidding begin.
Yeah.
And so suddenly the question, you have to ask yourself is, are drug prices increasing because of pharma, or are they increasing at a rapid pace because of the asks being done by the PBMs and carriers? And there's very little pushback because you now have roughly 3 entities that are anywhere from 80 to 90% of the purchasing power, again, depending upon how you're doing your calculation. And so you set the stage for where we are today.
Amazing overview. So are drug prices ultimately driven up by PBMs?
I mean, let's look at one of the main talking points whenever you see a PBM in front of Congress or some sort of piece that's been written up from one of their trade relation people, is that they'll say, we have done such a good job reducing drug prices. And I'm like, well, let's just look at a macro level indicator of drug pricing. So let's go back to the turn of the century. Domestic US drug pricing, totality, like utilization, top line, $120 billion. We're going to clear maybe $700 billion this year. Has the United States increased its population 500%? The answer is no, not even close. So would I be proud of a 500% increase in price on my watch? And so this far outpaces the consumer price index. Consumer price index, you would like to see in a normal period sub 2.5% if you could manage it there, compounded over time. I think that's reasonable. Drug inflation is compounding 5x that number at points. 4x easily. You're easily seeing 7% compounding inflation. And so what's the difference? Why is this behaving any differently from other industries, or in aggregate what the consumer experience should be? And the reason why people are like, well, why did this continue so long unabated? Like, why didn't someone do something about it? Because no one felt the pain until the last 5 or 6 years. And I just want people to think about that, because when you go back, I say turn of the century, drug spend was maybe 5-6% of total healthcare dollars. For some plans today, that number's north of 40%. There will be a world where, maybe it even gets closer depending upon utilization and demographics. So suddenly people are starting to ask questions. The other thing I think that started to drive questions was you couldn't hide behind copays as much anymore. So I think one of the interesting things is in the old days being turn of the century, you had a scenario where people wouldn't feel the pressure of copay. You'd pay $10 for a generic, $20 for a brand, $50 for non-preferred product, but it still was a flat number. And that could be hiding a $600 or $700 or $1,000 product.
Yeah.
Now, with the introduction of the Affordable Care Act, I think an unintended consequence was because metallic plans offered deductibles, it almost rationalized or made it easier for employer groups to accept the concept of a deductible plan. Like, hey, I need to reduce my overall spend by 20%. Let's insert a deductible or coinsurance. And then there were high deductible plans as well. So there's a period of time where the consumer or patient is exposed to price fully. So you have the price of, okay, this is a preferred drug. I'm used to paying $20 in a prior employer or experience, and suddenly it's $652.
Yeah.
Whoa, that's a big number. The other thing that you're starting to see for the first time is cost variability. So when you're hiding behind a $10 copay, it's $10 every time for my generic. Well, what if the generic was $4? We used to joke no one gets change at the register. Like you wouldn't see it in the old days. There was a period of time if a drug was cheaper than your copay, PBM just kept the money. And then even when you're in the deductible period and you're starting to see the price, why is my drug $52 one month, $74 the next, $68 the following? I go to a different pharmacy, it's $34. Like what is going on? And I think this is one of the areas that the PBM industry was doing perhaps a disservice to the American public, because drug pricing is not changing like the stock market. You know, it's not moving every hour of every day, a different price in every pharmacy for every drug. If you were to really understand the US supply chain of pharmaceutical product, it's very stable. US drug supply chain, you typically see drug price increasing in January and July, very predictable, and generics deflate typically over your purchasing on a quarterly or monthly basis, depending upon, you know, your purchasing schedule. But the whole point of it is there's not this erratic behavior in pricing. And that's artificially inserted because PBMs also are selling this notion of have and have-nots. Like you're a bigger plan, you deserve better pricing, but how do you know you have better pricing? Because even bigger plans of equal size have different pricing from each other, which is a little bit bizarre. And it's not like it's some sort of standardized tiering. The other thing that's occurring in this spread pricing model is PBMs have like what I would say decaying rates. So you'll start with a pretty competitive contract, but 3 years later, it's horrible. It just didn't keep up with, you know, combination of deflation on generics and higher rebate yield on branded product. And this really puts into question, is the PBM servicing the member and the plan, or are they just servicing themselves? Because you don't need this hyper opaque complex system if you're providing efficient and open access to real drug prices. You know, I think this artificial variability is a real problem for PBMs to defend. And, you know, it will most certainly come up if the FTC follows through suing the 3 largest PBMs on insulin prices. I mean, you just have to look at any claim record going back 5 or 7 years. It's going to look like insulin prices is a game of chutes and ladders. You know, like what is the true price of insulin? Like, and it's going to be all over the board, even for the same payers. And that's weird. And it's hard to explain.
So who runs a PBM at the end of the day? Like who is really making the decisions? You know, we talk to health plans, and at the end of the day, it's often the CFO who's making that final decision. Like who is it? Who at a PBM says, I'm making the calls here, I'm making the strategic decisions? For the big PBMs.
Well, the big PBMs are publicly traded, so
Yep.
their primary fiduciary responsibility is to the shareholder. So you could make an argument the shareholder is in charge because they want to maximize year-over-year, quarter-over-quarter earnings.
Yeah.
And so none of the existing management of any of the large PBMs or vertically integrated carriers created this model. This model spans decades and goes back to the turn of the century, and none of them were present, when this occurred. They might have been a junior associate or something in industry at one point, but they weren't developing the playbook of PBM. So they inherited years of efficiency and arbitrage and tactics and strategy and vertical integration. So who runs it? Obviously the section heads of each of those areas. So there's obviously a rebate team, there's a network team, there's an underwriting team, there's some sort of specialty mail order, so all of these groups are obviously tasked with maximizing return for their segment. And so at the highest level of any large company, it's very rare that the executive knows how things work. So to answer the question, coming around to it again, is, look, I think their business model is driven by expectations of their shareholders, institutional and individuals. I think that is only compounding the pressure to maximize a model that, to be fair, was, many people may say, was never designed to be thoughtful and considerate to the member in the plan as their primary objective. Primary objective of this business model was to squeeze as much money out of a very overly complex and opaque pricing system. And who does it benefit?
It's not the consumer.
No. And, I think no one would go out of their way and say, gosh, golly, what a wonderful experience this has been over the last 2.5 decades and counting. I think what you're starting to see is exasperation, mistrust. I think that's a word that comes up quite a bit now when I speak to large payers, is I have zero trust in the people that are talking to me and they're in charge of my infrastructure or providing me this benefit service. And so when trust is lost, I think the soul is dead, and I think the soul of the business model is really what's at stake right now. It's, I think the people that, back to their fiduciary responsibilities, are defending it to the bitter end. I think there are some large regional health plans, Blues health plans, that are really wondering, must I follow in the footsteps of this folly? Like, especially if I'm a Blues plan, I'm a not-for-profit or a nonprofit, and I'm, positioning myself as putting the care component ahead of some of these things because I don't have the same pressures. Do I need to follow in the footsteps of this folly? And so I think a lot of people being employer groups, unions, municipalities, state entities, government entities, and I think even health plans, none of the vertically integrated titans, but I think everyone else is starting to ask, what side of history do I want to be on when the ink dries?
Do you think it takes government regulation to ultimately shift the titans, or to do that? Because they're so vertically integrated, they're such massive players.
Yeah. I think the complexity of the U.S. supply chain and drug pricing system, that's not an easy fix to have regulation sweep in, because everything is connected or interconnected. Everything from most favored nation, different types of state and federal pricing programs, different types of incentive pricing programs like 340B and other areas. And so you can't necessarily unwind the past. You could change the future.
How do you change the future?
You could say in the future, we're no longer going to play this multi-tier shenanigans game. We're going to have one price. What's the real price of the drug? Because think of it the evolution of a drug. You start as a branded product. You have a high price. To gain market access, you're offering a high price with a rebate. And then there's some sort of discount through different layers of wholesaler and retailer and PBM, et cetera. But really, there's this concept of gross to net. Gross is your starting price that nobody really pays. And then net price. You know, the sad thing is, a little side note, is the only one who ends up paying gross sometimes is the most vulnerable population. Like, you're in the area of, I'm not covered by a government program, like under Affordable Care or Medicaid, and I don't have insurance, so I'm paying cash price. That's the person who's really being hit.
Yeah.
And that's such a shame, I always say, is, you know, why is the person who we should be looking after the most typically getting hit the hardest under this model? Because they're not covered by the shield of insurance or subsidies or other things. And so, you know, getting back to, you know, where we are in this model and, you know, the story of a claim where you start as a branded product, high price, you have some sort of rebate, and then it goes off patent. And when it goes off patent, it moves to a generic, and depending upon the number of manufacturers and the popularity of the brand, you could have anywhere from a handful of manufacturers to dozens making the product. I mean, let's take a popular statin like atorvastatin. You know, it might be 23 manufacturers, which is why it probably discounts north of 92% from its list price originally. So the point in the future is, could we just start at the low price? Like, instead of the shenanigan of, I have a drug and it's $5,000 every month, but it discounts 60%, you know, couldn't we just kind of start with a $2,000 number? You know, instead of this game of higher price, lower through some sort of rebating structure or incentive structure. So you could technically address the future. I just don't think you could unwind the past. So what you just need to do is ride out patents. So on the high tide side, maybe you got to wait, you know, 12, 15 years, and you get rid of everyone's patent and patent extensions, and you're done.
Yeah.
And then going forward, Brave New World, drugs priced the way they should, which is more what I say, you go into a pharmacy and you go into the over-the-counter section. You know, you pick up eye drops, a bottle of Advil or vitamins or anything. You know, it's one price, you know, and if someone is insured or uninsured, it's the same price. And if someone comes in 20 minutes later, it's still the same price. So, you know, I always say there is a pricing model that exists. It's over the counter. And if you wanted to address the future, it should behave more like an over the counter pricing structure. You know, and I think that's one way to address the problem. The other way would be to deconstruct the vertical integration and say, look, if you want to make money on drug spend, be a manufacturer, be a wholesaler, operate a pharmacy or a health system distribution, you know, for inpatient, outpatient utilization, or a GPO, you're some sort of rebate aggregator, but don't be an administrator.
Yeah.
And I think there are some bills on the Hill that are emerging with similar language, which is pick what you want to be. You know, it's this concept of you can't be on both sides of the equation. You can't be making money on drug spend and steering people to drugs. You can't be in charge of clinical outcomes and make money on certain drugs and dispensing and overutilization. I mean, you know, one of the weird things that you see are these stockpiles of medication. So through home delivery, you know, if you're on 90-day supply, drugs are being shipped maybe every 65 or 70 days. And it's done under the guise of, we want to make sure the patients have their medication, but at the end of the year, you're ending up with what we call medication possession ratios, the days outstanding versus the days supply. And you have much more days supply than days outstanding. And so you suddenly have 30 to 20% excess medication each year. And who benefited from that? Well, the person that makes money on drug spend. And so I think once you remove that incentive of I make money on drugs, you're going to get pure decision making. You're going to have collaboration, thoughtful engagement around outcomes of the patient, and adherence and better service and patient access, instead of, unfortunately, or fortunately, however you want to view our publicly traded markets, which is they have to consider the shareholder first in this decision tree. And so I go back to, I think one way to fix it would be address the future. I think another way to address it is to just bifurcate or rip apart. If you want to make money on drugs, you have to fall into one of these categories. But you can't own these assets anymore. You know, they can't be subsidiaries and there's a firewall and
A firewall.
yeah, and it's not. It goes to the same bottom line of earnings. So that doesn't work. And so I think separating that out, if you want to administrate, have that responsibility. Be aligned with the patient and the plan, because you don't make money more or less on any decision. You're paid on a member basis or prescription, it's flat. I think the third way that you could at least cure some of this, but not fix it to the same extremes as the other solutions, is if you were to provide more price availability. And what I mean about this is, I say this all the time, if you were to go downstairs and order a cup of coffee at your local coffee shop and someone said, hey, the bill is $4.50, I'd be like, okay. But if someone tried to charge me $52 for the cup of coffee, I would be like, that's a heck of a cup of coffee.
Yeah.
But imagine it's the same cup of coffee you're always getting. I'd be like, why is it $52? You would be outraged because you have price experience. You can rationalize price because it's freely available, that price. I think the biggest disservice to the American public today is there's no understanding of what real drug prices are. The closest you get is CMS post NADAC pricing, which is National Average Drug Acquisition Cost. But you know, not a lot of people are going there and downloading the weekly file and looking up their drug, because you know, they may not have experience in manipulating a file of that type, or even identifying their drug. It may be difficult in an NDC-11 sequencing versus the label name and trying to find that, and obviously convert to the correct quantity and the correct, you know, units that are being dispensed and things like that. So I think one of the things that could really help, not fix everything, is if everyone understood in the public domain what a fair price is.
Yeah.
Back to my cup of coffee. Like, I have this drug, I know a fair price is $125. If it's $300, no, thank you.
Yeah.
If it's $115, awesome. I'm getting a great deal. You know, my cup of coffee goes on sale periodically.
Yeah.
It's $4 today. You know, it's after 10 o'clock. Awesome. But I want the American public, you know, if I could wish for one thing, to have access. Now, I do believe the government plays a role there, that the government, which does obviously fund CMS and NADAC pricing by association, that you could have the federal government broaden and make that publishing more accessible to the average American. So you don't have to be sophisticated and know where to go on CMS. I think that's a huge benefit. You know, it's a massive public service that wouldn't cost a lot of money to maintain. I mean, at any one time, there's maybe 120,000 unique NDC-11s, but each NDC-11 represents different manufacturers of the same drug. It also represents different, like, bottle sizes and milligram strengths. But so if you really wanted to think about how many things or drug prices are used by a large plan, maybe 20 or 30,000, that's it. And people will be like, well, that's a lot. I go, is it? Amazon must maintain tens of millions of prices on its website.
Easily.
You know, Walmart, you walk into that store, tens of millions of SKUs.
Yeah.
If you were to look at even, you know, your local pharmacy or even hardware store, they have thousands of products.
Yeah, think about Home Depot.
I'm pretty confident the federal government could create a public register of these prices that's not just accessible in a downloadable format for more sophisticated payers or administrators, but to the average American.
Yeah. It all gets back to the incentive structures and the people who control it today have very little incentive to push and be transparent and be upfront about any of the pricing currently, and it's complex and opaque. So,
well, one of the biggest sins of this process is if you think about manufacturing, the average manufacturer has a binary identification system. It's either patent protected or it's not patent protected, which in many people's minds may equate to it's a brand and a generic. It's some sort of branded product. It could be a specialty product. It could be some sort of small molecule branded product, but it's protected by a patent, which typically means higher price.
yeah.
And then there's something that's off patent, and that's it. But in the pharmacy benefit, opacity, and complexity, we have a classification system that not just varies carrier to carrier, but plans within those carriers at times. And so you can have something that at the same second, in the same big PBM, it could be a brand, it could be a generic, it could be a single source generic, it could be a multi-source brand, it could be a single source generic with a DAW handling code that changes its classification. Again, it's limited supply, it overrides all classification. And someone would be like, well, is this being done for my benefit? Clearly it's suspect, because no one else uses this terminology and language in the supply chain.
Yeah.
I have a price, it was sold, we move on with our day. I always get a chuckle when someone says something is limited supply, but it's on the shelf. And even better, if you were to ask the retail pharmacy, are you getting a better price because it's limited supply? They're going to look at you and laugh with them, be like, no, I'm going to get reimbursed probably underwater on this drug. And so, again, is the more you peel back this business model of the modern PBM, the stinkier it kind of gets.
Yeah. Hey, Joe, I want to be respectful of your time. This has been great.
Well,
This is awesome, man.